Good evening, I guess good afternoon or good morning, depending on where you're joining us from. My name is Richard Payne and I'm a trainer here at Fitch Learning, focusing on CFA program and the CFA program exam. Now, what we're going to be looking at today is one of the trickier areas of probably the most important and trickiest topics when it comes to the CFA program level 1 exam. Deferred tax. Now, FRA is the essential part of your exam. It is the most important part by far. And what you will find is that deferred tax is an area that typically people spend a while trying to get to grips with, and when they don't master it, they just move on and they look at other topics. So what I'm going to look to do over the next hour is to make sure that anything that relates to tax, anything relates to deferred tax, we're clear, we're confident, and when those questions come up, we can answer them in 20-30 seconds and take that extra time to use on other parts of the exam. So let's have a look. Now, the general reading is on deferred taxes. I'm not going to go through this. What I'm going to focus on is what is a tax expense. I'm then going to look at the current portion of a tax expense. How do I calculate it? And then we're going to get stuck into deferred tax, and we're going to do a bunch of questions to make sure that we've mastered it. One question to see in practice what it's doing, and a bunch of questions to make sure we can answer those shorter, faster questions that come through. So we're just going to start by looking at some terminology. And the first two that I want us to look through is this difference between an accounting profit, which is the profit that I see in my financial accounts, and what is taxable income. Now, taxable income is what the tax authority uses to determine how much tax you're going to have to pay in the period. And those two are very, very different. What we're going to look at doing later is taking a figure in our accounts and adjusting it back to a figure that the tax authority is going to use to charge you tax on. And then the taxes that I'm going to pay are going to be based on this, my taxable income, times by whatever the statutory income tax is. Now, some other terms that we're going to have a look at is firstly this income tax expense. Income tax expense is a tax expense you see in your accounts. Let's write in here, per your financial accounts. And this is made up of, well, 3 parts. We're going to be looking at 2. I always call them the ghosts of present, future and past. But essentially you're going to have one portion in this tax expense which is going to relate to your current tax bill. Now, your current tax portion is going to be when I look at my taxable income, which we said is the tax authority's figure of how much I'm going to pay tax on. And I'm going to times that by the statutory income tax rate. I'm going to say here, all permanent differences go through here. If there's a difference, it's always going to stick about. It's part of my current tax calculation. I need to have a look at what the tax authority says I should be basing my tax figures on, apply statutory income tax rates, and that is my estimation of how much tax I need to pay in the period. Now, bear in mind that's an estimation. I will get it wrong. Not just me personally, whoever does it, they're going to get it wrong pretty much every year. And therefore, there is going to be a correction in the current year for past errors. Now, good news. In the CFA curriculum, in the CFA program curriculum, we're going to assume that actually when it comes to past errors, let's just ignore them. Let's assume that you can estimate exactly what your tax charge is going to be for this given period. So this past errors, I'm going to put it in brackets because according to the CFA program curriculum, we're going to assume that we can estimate accurately. And the final part which we are going to focus on is the part of your tax expense that relates to the future period. And this here is talking about deferred tax. And deferred tax is all about temporary, not permanent, differences. Differences between my tax authority and my accounting standards, which I think are going to reverse out in the future. And that's going to be the focus of most of this lecture today. Now, the last term that I'm going to very quickly look over is income tax paid. And this term is saying, what is the cash payment of my tax? Very different to my income tax expense, which is made up of a current charge to be paid and also a future charge deferred into future periods. This is how much have I actually paid during the period. And if I'm thinking about the accounting for this, when I make the payment, I'm going to find that my cash comes down. And when my cash comes down, my tax liability is also going to come down. I owed the tax authority 100 million in tax. Well, if I pay that 100 million, my cash goes down by 100 million, and my tax liability has gone from 100 million payable to 0. So those are our accounting terms. And what we're going to do is we're going to look at the current portion of our tax expense, and then we're going to focus on the deferred tax portion. So we're going to have a look at that current portion first. And we start off by saying, why is our accounting profit different to our taxable income? Our taxable income is what I get taxed on. And essentially, the tax man doesn't follow accounting standards. He follows his own set of rules. And that's going to provide me a difference between my profit before tax and my taxable income. And this difference in my current portion of my tax is going to include any permanent differences that I have. So any differences where I say actually they're not going to be allowed through my tax authority ever. In which case this goes through the current portion of what my tax charge is. Examples of permanent differences. We've got stuff like muni bond interest. Well, if that is tax exempt, then that is income that goes through my profit before tax. But my tax authority says, well, you're not going to pay any tax on that portion. And therefore, I will strip this income out of my accounting profits. Tax credits for expenditure. And here we're talking about permanent tax credits. Those are never, ever going to reverse out. Now, the last thing that I want to look at on this slide is my effective tax rate. My effective tax rate is my income tax expense, which is my tax expense per my income statement. Remember, made up of a current portion and made up of a movement in deferred or a future portion. It is that tax expense divided by my accounting pre-tax income. And we're going to see a couple of examples in this, but it's going to be my income tax expense, the charge that goes to my income statement, divided by my profits before tax. So, tax in the income statement, fine. We don't have to dwell here, but we know that it's made up of both of the current portion of your tax and also the deferred portion of your tax as well. Let's start with this, the current portion of your tax. I said that there is a difference between profit before tax in my income statement and my taxable income. So on this portion, what we need to be comfortable with is taking a profit before tax per my income statement and adjusting it all the way down to a taxable income. So what are we going to do? I said you're going to have to take out permanent differences. For example, I said tax exempt income like a municipal bond. This is a permanent difference. If I have pre-tax income of 20 million and 2 million of that is a municipal bond, which is tax-free in this situation, well, I only have to pay tax on 18 million worth of income. So I'm going to strip out this permanent difference, which is an income. That income is tax-free. So I will change the colour of that writing. So I'm stripping out my permanent differences. When it relates to income, that's a minus. Some of that income is not going to be taxed. What I'm then going to do is, if I had tax exempt or a tax expense that was going to go through permanent difference, I would add that back. But really where our focus is our non-tax deductible expenditure. The key one you're going to see is depreciation. Now, depreciation is an accounting term. It is not a tax term. What we'll get instead of depreciation is we'll get something like a tax allowance for depreciation. Something like a capital allowance. So currently I have depreciation going through my profit before tax. I need to strip out the impact of depreciation and replace it with my capital allowance for depreciation. Now, if my profits before tax are 20 million, and that is already including depreciation of 5 million, my profit of tax, or my profit before tax, would have been 25 million before depreciation. And that 5 million depreciation has brought it down to 20 mil. So how do I strip out the impact of that depreciation? I add it back. So in this example that I've purely made up, I'm going to add back 5 million in depreciation. I'm just making up numbers here. Which is saying my profit before tax would have been 25 million before that depreciation charge went through. And that's pretty much the same as when we do our cash flow adjustments in CFO. I am adjusting out the impact of depreciation. And instead of this 5 million depreciation charge per my accounts, what I get to deduct instead is the capital allowance for depreciation. And let's just say, made up number here, the tax authority says I'm going to allow you to take a deduction of 7 million. Instead of the 5 million depreciation I've charged, I get to take out 7 million instead, bringing my taxable income lower. And it's a case of running through these different adjustments to say, actually, where do I end up? Well, I've got 20 million minus 2 plus 5 gets me to 23, minus 7 takes me down to 16 million. And it is this 16 million that I get taxed on at the statutory rate. So my profit before tax is 20 million. That's there for me to see in the accounts. The amount in this period I'm actually going to get charged tax on is going to be 16 million. And if the statutory rate is 10%, my tax charge for this period is going to be 16 million times 10%, 1.6 million. So that is just me making up examples here. But what we're talking about is adjusting from a profit before tax in my accounts down to a taxable income which the tax authority is going to use to charge tax on. And on the next slide, we've just got an example of this. So we're saying, okay, we've got a company, they've got a pre-tax income of 10 million, We've got a statutory rate of tax of 30%. This 10 million includes a tax-free income of 1 million. Calculate number one, the taxable income. And taxable income, I've said we take a profit before tax, which is 10 million, and we're then going to adjust it. We're going to adjust out any permanent differences when it relates to income. So there is 1 million of income in there, which relates to a municipal bond, which I'm never ever going to have to pay tax on. So we've got my tax exempt income. I'm going to put a Y for income. This is a permanent difference. And then, I mean, in this example, we've got nothing more. So my taxable income is going to be 9 million. And it is that 9 million that I pay tax at 30% on. So 30% of 9 million, 3 times 9, 27, it's going to be 2.7 million in tax. I'm just going to write up here, that is my 9 million times 30%. So that's my taxable income. My income tax owed for the period is going to be 2.7 million. Tax expense is made up of that and any movements in deferred tax. But here we don't have any movements in deferred tax. So both of these are going to be the same because there is no movement on deferred tax. So both of these are going to be 2.7 million. My effective tax rate, I hope you haven't forgotten, is going to be my tax expense in my income statement divided by my profit before tax, which is the 10 million that goes through my income statement. So my effective tax rate ends up at 27%. And hopefully that makes sense conceptually, because you've got 10 million of income, of which 9 million you're going to be charged 30% on, and 1 million you're going to be charged 0% on. So 1/10 of that 10 million is going to have no tax whatsoever. Instead of paying a 30% rate of tax, which is my statutory rate, 1/10 of that is going to have 0 tax whatsoever. And therefore my effective tax rate is going to be down by that 10%. It's dropped by 10% down to 27%. So that is the current portion of your taxes. And I won't go into that any further, but I think conceptually that is the areas, that calculation you need to do. Maybe that's a little bit easy, this example. I think the added thing that we could do is say, well, there was depreciation and you had an allowance for depreciation. In which case I add back my depreciation to strip out the impact of it. And instead I take out my allowance for depreciation. So that is the current portion of my tax expense. But the focus for the next 40 minutes is not going to be on the current portion, but it's going to be on the portion of your tax expense that relates to future periods. What we're going to be having a look at is this, the deferred tax element of the tax expense that goes to the income statement. So what you're looking for are temporary differences. Differences that are going to reverse out in the future. And probably the most common temporary difference you're going to have is going to be for depreciation methods. My accounts say that I'm going to depreciate over 10 years. The tax authority says that asset needs to be depreciated over 15 years. Now, after 15 years, I end up with the exact same asset, an asset that's been depreciated down to 0 or whatever the residual book value is. But in the short term, one's going to charge more depreciation than the other. And this is a temporary difference that results in a deferred tax asset or a deferred tax liability. Maybe the other example that often gets used is a warranty expense. I've just bought myself a new phone, and that phone has a warranty that says if it breaks in the first year, you can bring it back to us and we'll fix it. Now that company who sold me the phone should make an estimate of how many phones break in the first year and what the average cost is to repair them. And they're going to recognise a provision for this cost. That provision will go through the income statement immediately as they sell the phones. But the tax authority says you only get a tax deduction when you actually pay the cash to repair the phone. So over time, if my estimates are correct, those will end up the same. But in my accounting standard, I recognise a liability immediately. When it comes to my tax standards, I'm going to follow when I physically pay the cash. So, we're going to get into deferred tax assets, liabilities. Let's get stuck into the pro forma that you should be using on any deferred tax question. And you always set this up in exactly the same way. So let me just insert a blank new page here. If you've got some space, if you've got paper in front of you, write these down. Essentially, you only need to learn it once, but I'm going to write out pretty much every single way that you can use the same pro forma. And what we'll do is we'll write it out for deferred tax assets at the top, and then at the bottom we'll do it for liabilities, deferred tax liabilities. Cool. Let's write this out for every single question exactly the same. And what you should always be doing is saying, what is the balance if I'm looking at, let's write here, an asset balance. What's the balance in my accounts versus what is the asset worth according to the tax authority? The difference in these is going to form a temporary difference. And it is that temporary difference that I apply a tax rate to end up with a deferred tax asset. Now let's just talk about the way that you apply this. If you have an asset per your accounts which is smaller than the asset according to the tax man, you always go accounts minus the tax figure. So a little asset minus a big asset is going to give me a negative number. And then I'm just going to apply a tax rate to it like I would if it was in my income statement. And remember, the tax is always the opposite sign. So a negative temporary difference will give me a positive deferred tax asset. And let me just put some numbers in there so we can see it with that. I'm going to make a random assumption. Let's assume our tax rate is, to make it easy for me, you're probably fine. My math skills probably isn't as good as yours. Let's go, our tax is 10%. Which says if our asset base in our accounts are 80, and per our tax authority this asset base is 100, this gives me a temporary difference of minus 20. And when I apply a tax rate of 10% to this temporary difference, I end up with a deferred tax asset when it's positive of 2. Now that's applying the pro forma. You care about understanding the logic as well, I hope. So I've got this amazing new laptop in front of me, and let's just say this asset, this laptop in front of me, is worth $80 according to my accounts. If I were to sell this laptop that is worth $80 according to my accounts for $80, my accounts say that I've made no gain or loss on my disposal. But the tax authority says, hold on, that laptop you're holding isn't worth $80. According to us, it is worth $100. If you were to sell this laptop, which the tax authority said is worth $100, for $80, the tax authority says, actually, you've just made a loss of $20. You've just sold an asset we think is worth $100 for $80. That is a loss of $20 on disposal. And that loss of $20 on disposal, you get a tax benefit of, +2. But I'm not going to take that tax benefit now, because I'm not selling this laptop for $80 today. I'm going to defer that tax benefit to the future. And that is your deferred tax asset. Now, why might it be that I have in my accounts a laptop worth 80 where the taxman said it's worth 100? And that is going to be to do with differences in the most common that they'll talk about, depreciation methods. I want to show you the flexibility of this pro forma, because it doesn't matter whether I think about it in terms of the balance sheet, which I typically do. I can also do the exact same pro forma for my income statement. I'm going to write TD for temporary difference. So, if I originally had a laptop that I bought for $120, and what I'm going to do instead is charge depreciation of $40 in the first year according to my accounts. So my laptop was originally, at T0 was 120. Per my accounts, I'm going to charge 40 of depreciation. And the key thing you need to remember here is depreciation is negative in my income statement. You keep that sign convention. My tax authority have only depreciated it down to 100. So they've only charged depreciation of 120 minus 100 of 20. They've gone from 120 up here down to 100 here. In which case, minus 40 minus 20 is going to be, believe it or not, minus 20. The exact same figure we've got here. And I apply a tax rate of 10%. My deferred tax asset is +2. So here I'm saying my accounting depreciation is bigger than the depreciation that I have according to my accounts, and that gives me a negative figure, which gives me a positive deferred tax asset. And I could do this for depreciation. I could do this for profits. Imagine my EBITDA before depreciation and amortization were, let's say, 500. In which case, my accounting tax, once I take out the 40 depreciation, is going to be 460. Here I'm taking out 20 depreciation from my 500, according to the tax authority. 480 is my taxable income. In which case, I have a difference of minus 20, which I apply a tax rate of 10% +2. I can use this pro forma in any given situation. And I can use it for assets. I can use the exact same thing for liabilities. So if I do the exact same for liabilities, I've got per my accounts, per the tax authority, I've got my temporary difference, and I'm now looking for a deferred tax asset. Well, I know this has to be negative for this to be positive, which means I'm going to end up with a liability which is bigger in my accounts than according to the tax authority. Big L is what I'm trying to write here. And then we've got a little l. Let's just say that I have a liability of $100 in my accounts, and the tax authority says, well, in fact, let's say the tax authority says you have no liability whatsoever. So I can make that a smaller L if I want. I can make it 0. I have in my accounts a provision for a warranty of 100. And the tax authority goes, nope, you do not get to make a provision. When the cash expense gets incurred, then you get to deduct it. But today you get no provision, no liability whatsoever. If I were to settle all of those warranty expenses for $100 in cash, then according to my accounting standards, I've made no gain or loss. I recognised a liability of 100, I settled the liability for 100, no difference. But the tax authority has said your liability is currently 0. If I then pay out 100 in warranty expenses and fixing those expenses, that is a loss in that period of 100. And it is a loss in that period of 100 that I get a tax benefit of 10. Assuming that my tax rate is still 10%. This pro forma works in every single situation. But you need to remember when you're talking about a liability, preserve the sign, the negative sign. And the same, if I'm talking about my income statement and it's a negative figure, preserve the sign. I can do it for my assets. I can do the exact same thing for deferred tax liabilities. So once again, per accounts, per the tax authority, if this is bigger than this, I end up with a temporary difference that is positive, which is a deferred tax liability. I have an asset worth 100. If I sell it for 100, there is no gain or loss. If the tax authority says that asset's only worth 80 in our books, if I were to sell this for 100, the taxman says you've made a 20 gain. So no gain in my accounts, but the taxman says, according to us, you've made a $20 gain. And that $20 gain will incur a tax charge. At 10%, I'm going to say it's going to be $2. But I'm not going to incur that tax charge today because I'm not selling the asset for 100 today. I'm going to defer that gain to the future. And I can do the same on my liability side. Little L per my accounts. My tax has a big L. That is going to give me a small negative minus a big negative is going to give me a positive figure. Let's just say that this is minus 80. This is minus 100. Minus 80 minus 100 plus 20. And that is going to give me a negative, assuming a 10% tax rate again. I'm not going to change for this example. It's going to give me a tax liability, which I defer, of 2. And if I can do it on the balance sheet, which I typically like to, I can do the exact same thing when it comes to my income statement. So if I'm to have a look at my income statement, and let's just do it like this. Let's say that I have a gain on my asset. My asset was originally 80. And let's just say here, I have some sort of fair value movement of 20. And the tax authority goes, we're not going to give you that gain until you sell it for 100. But my accounts say, in this situation, let's just say we're allowed to recognise the profit. I know that typically you're not going to be able to. If it's something, say you're allowed to recognise the gain on what your asset is. In which case, in my positive and the 20, and here what I'm going to do is just apply the tax rate at 10. Essentially that gain is attracting some sort of $2 tax charge. But I'm not going to recognise the gain today. I defer it to the future. And that right there are all the pro formas that you can be asked. And they can ask conceptual questions, they can ask calculation questions. But that pro forma will always hold true. So this is a slide which is saying what's the difference? Fine. Ignore this. What I want us to focus on is this pro forma. And just because we're running short on time, let's do an example which is more complicated than what you'll see in the exam. And then we'll run through some short examples of just applying that pro forma as we go through. And I want you to go along and be doing this as I do. So we've got a company, and we've got a company that's bought an asset for $9,000 with an estimated useful life of 3 years, no salvage value. And they're going to depreciate it in their accounts using the straight line method, which means they're going to charge the same amount of depreciation in every one of the 3 years. They're going to charge depreciation of $3,000 every year. But the tax authority says, hold on, we're not going to allow you to depreciate it $3,000 a year according to what you're going to pay us. You need to take $5,000 in the first year and $4,000 in the second year. And in the last year, you've already fully depreciated this asset. What we're going to do is we're going to calculate all the way down to our effective tax rate if I have no deferred tax and if I have deferred tax. So remember, our effective tax rates, our tax expense is going to be made up of the current portion of your tax as well as the deferred portion. So what we're going to do is we're going to have a look at calculating our tax expense first. And let me just draw on a new slide here. So stage 1. Let's calculate the current portion of my tax expense. So I meant to add, if you do have questions at any point for this, please do post them. They'll be filtered, they'll be sent through to me, and what I will do is I'll do my best to answer any questions that you have as we go along. So we're calculating the current part of the tax expense. And I said, when it comes to the current part, we're going to take our profit before tax according to our income statement, and we're going to adjust this all the way down to our taxable income. You've already done one of these questions. So our profit before tax is given to us. We're told that our profit before tax, our EBITDA, is going to be 10,000. So let's do it in every single year. Let's go T1, T2, T3. In every single year, my profit before tax, I'm just going to move this down slightly, is going to be 10,000. But this profit before tax is currently including depreciation. Depreciation of 3K per period. Just bear in mind, and in fact, sorry, this is my EBITDA. So my EBITDA is going to be 10,000 every single period. And what I'm then going to do is I'm going to strip out depreciation in my accounts. And that will take me down to my profit before tax. Now, you don't have to do this part. This part is just showing you why we add back depreciation. Because what we then say is, well, this depreciation charge that's gone through shouldn't be going through. I don't get that when it comes to the tax authority. So what we're going to do is we are going to add back depreciation. Now what I've done is just massive overkill. I've taken an EBITDA figure, stripped out depreciation to get to a profit before tax, just so you can see it. And then I'm saying, well, that profit before tax of 7K per year has a depreciation charge, which is nothing to do with my tax charge. In which case I need to add it back to strip out this negative impact that it's had. Fine, massive overkill, but it's worth seeing that in action. Because instead of depreciation, what I get instead is a capital allowance for depreciation. And the tax man has said very kindly, I get to take away 5k in the first year and 4k in the second year. So I'm going to take out instead 5k in the first year, 4k in the second year, then my asset's fully depreciated. So my taxable income is going to be 10k, fine, I can cancel those out against each other. 10k minus 5k is going to be 5k in the first period, it's going to be 6k in the second period, and in the final period, it's going to be 10k. Because I do not get any capital allowances. I've used them all already. Now my tax rate is 40%. So the amount I'm going to pay, I'm going to put here tax at 40%. Well, 40% times my taxable income of 5 is going to be 2 million. 40% of 6, 2.4 million. And then I've got my 10k, not 100k, my 10k at the end. And that is going to be taxed at 40%. Or 4 million. That is my current tax charge. And I'm going to write the term current up here. So if I'm now calculating what my effective tax rate is going to be, I'm going to take my accounting profits. So according to my accounts, let's go T0, T1, T2. I have profit before tax of 10k minus 3k. And in fact, let's write this out fully like we did on the last slide. Let's bring in my EBITDA of 10k per my accounts. And we're now talking per my account, so I have in depreciation of 3k. And this gets me down to my profit before tax. If I then strip out the current portion of my tax, I'm taking out 2 million, then 2.4 million, then 4 million. So I'm going to take out 2 million, 2.4 million, then 4 million. And let's just calculate down at the bottom in a different colour. I'm just going to calculate my effective tax rate where there is no deferred tax. Well, that's going to be 2 divided by 7, 2.4 divided by 7, and 4 divided by 7. So I'm just going to quickly calculate those. 2 divided by 7 million, 28.6%. 2.4 divided by 7, I'm getting 34.3%. And then we've got the whopper, 4 divided by 7. That is an effective tax rate of, just going to move that across, 4 divided by 7, 57.1%. Absolutely huge. Notice that my tax rate is lower than my statutory tax rate of 40% at the beginning, and it's higher at the end. And that's what's going to happen when I have no smoothing from deferred tax. Now let's have a go at calculating deferred tax in every single period. And remember I said you can do this from an asset point of view. I can do this from an income statement point of view. So let's now add a new slide. If I can. Hopefully I can. Yes, I can. So I'm just going to open up a new slide And now I'm going to do my deferred portion of my tax expense. Let's run through this then. You can do it from an asset point of view, or you can do it from an income statement point of view. I don't care which you choose. I typically do asset. So if it's okay, I will do that. So we've got T0, T1, T2, and T3. And I start off with an asset that I buy that is worth £9,000. And it doesn't matter, the tax authority says, yep, you have paid dollars for that. So at T0, there's no temporary difference. And there's no deferred tax movement. But at T1, according to my accounts, what I'm going to do is I'm going to strip out, hopefully we remember the figures, I believe it was 3K of depreciation. Yes, it was. Straight line over 3 years. So this is going to drop down to 6K at T1. It's going to drop to 3K at T2. And it's going to be worth nothing at the end of T3. Whereas the tax authority says deduct 5K in the first year and then 4K in the year after. So this asset is going to go from 9. It's then going to go minus 5K. Minus 4K. So it's going to drop down to 4K. It's then going to drop down to 0. Always my accounts minus my tax, or my tax base that we will have a look at. And my tax base here is 4,000. So that is a temporary difference of 2K. That is a temporary difference of 3K. And then we've got no temporary difference whatsoever. And my deferred tax is going to be an asset or a liability. Hopefully you are all thinking in your head, this is going to be a liability. I've got a positive temporary difference, and therefore this is going to be a liability. Well, it's nothing in the first year. I've got a tax rate at 40%. So in T1 it's going to be 40% of 2K, 800,000. Sorry, $800,000, $800, 0.8K. And then it's going to be 40% of 3, 1.2K, 40% of nothing, it is nothing. So that is the movement of my liability. My liability is going up by 0.8K. So my liability increases by 0.8K in the first period. And then my liability increases by 0.4K. And then my liability drops down to 0. So it falls by 1.2K all the way down to 0. And then we go back to our basic accounting principles of going, an increase in liability is going to come through as an expense. So here I've got 0.8K. Sorry, just notice those are K. And this is the deferred tax part of my tax expense. In the second year, my liability increases by 0.4K. So that increase in liability is coming through as 0.4K. And in the last year, my liability falls. My liability gets reduced to 0, which is now a tax benefit of 1.2K. And remember, I said that your tax expense is made up of both of these, which means my tax expense is 2.8K in the first year, 2.8K in the second year, and minus 4 plus 2, 2.8K in the third year. Which for those of you leap into the dramatic conclusion of this example, is 40% of 7k. So what I've done is I've got back down to what you would expect to see in your income statement when you look at the profit before tax. And I've taken a current tax portion and I've adjusted that for the movement in my deferred tax. And that example is far more than you need to go through, but it's a good way to get us used to seeing that across periods. Now let's have a go with some easier examples. So let's just have a look at our warranty expenses. I've got a warranty provision of 100 grand. In 2000, in 2008, in 2009 the cash gets paid. So what we're going to do is we're going to have a look at what's going to happen in 2008. We can also have a look in 2009 as well. And remember, I said you can do this from a balance sheet perspective, or you can do it from an income statement. And I typically prefer the balance sheet, so I'm going to stick with the balance sheet if that's okay. So in 2000, and let's say this is 18, per my accounts, I have a liability of 100,000. This is a warranty provision. It's a liability. According to the tax authority, my provision is nothing. In which case, my temporary difference is minus 100,000. And therefore, my tax, and let me just assume here that the tax is at 10%. Let's make it easy. My tax is going to be a benefit of 10k, which I'm not going to take now. I'm going to defer to the future. I can do it from a balance sheet point of view. I can do it from an income statement point of view as well. And I can say, well, when it comes to my accounts, my income statement is going to have a charge of 100k coming through in the first year. Keep that sign. My tax is going to allow me a deduction of nothing for my profits. And therefore, I end up with a temporary difference of minus 100. My tax is an asset of 10k, assuming that I've got this 10% tax rate. And in 2019, my accounts will say, if you actually manage to settle these for 100,000, as we've been told, over here, and let's just say 2019, the cash gets paid. So my accounts are going to say, you no longer get a deduction. You took your deduction in 2018. There's no more deductions taken in 2019. But my tax is going to even this up. My tax is going to come through and they're going to allow me a deduction of, well, what I will end up with, and actually I'm going to do it from a balance sheet point of view. No deduction here, no deduction here. I have no temporary difference, and therefore I have no deferred tax. And where I had a deferred tax asset of 10k before, this is going to come down to 0. I'm going to reduce my tax asset to 0, which is going to be an additional expense of 10k coming through my tax line. And that's the same as saying in the income statement, I've got nothing coming through here. I'm allowed a tax deduction of 100k. Well, that minus that is going to get me a positive figure, which is going to come through as an expense of 10k. So a positive 100k. And I therefore have an expense, an additional tax expense of 10k, which is this movement here in my balance sheet. That pro forma always works. So let's do some more. We've got some assets. Number 1, I have dividends receivable of 2 million from my subsidiary, and dividends are not taxable. What's the movement or the deferred tax impact? Hopefully you're going, absolutely nothing whatsoever. This here is a permanent difference. If these dividends are not taxable now, they'll never be taxable. They'll never go back and tax a past dividend, which was not taxable at that time. So in which case, permanent difference, no deferred tax impact whatsoever. This will all go through the current portion. I capitalise 5 million of development costs. I bring it down on a straight line basis over 5 years, so 1 million per year. But amortization is allowed at 40%. Set up your pro forma. Hopefully you're doing this through with me. Let's just say from a balance sheet point of view after 1 year. Well, I've got 5 million of development cost and I'm charging 1 million per year of depreciation. So my accounts will have a balance of 4 million. Whereas the tax authority allows me 40%. So 5 million times 60%, what's left, or 5 million times 1 minus 40%, I end up with a tax asset of 3 because there was 2 million depreciation. And you know what? Let's put the depreciation at the same time so we can see this. So the depreciation is 1 million over here and 2 million over here. And remember to keep those signs on. Well, from my asset point of view, I've got a temporary difference of positive 1 mil. And for my income statement charge in this year, I'm looking at 1 million minus 1 million minus 2 million. Well, that's a mouthful. But I end up with plus 1 million as well. So my deferred tax liability, you should be thinking, is going to be, given my 10% tax rate, 100k. And let's write that as 0.1 million. Whereas over here, the exact same logic. So remember, it doesn't matter if I do it from an asset point of view or depreciation point of view. Now, technically, what you're seeing for the depreciation movement is the charge during the period, and what you're seeing in the asset is the overall position. But if this is the first year I'm looking at, those two are going to be the same. Number 3, we've got a company and they've provided 250 as a general provision for doubtful receivables, which have a gross value of 3 million. The tax authority does not allow deductions against provisions. Cool, I think we've done pretty much this exact same example with a warranty. So I now have a provision per my accounts, a liability of 250k. And the tax man goes, nope, you don't get that deduction. Which is going to be a provision of 250, a minus figure, minus nothing, is going to give me a negative figure of 250. And just assuming that I've got a deferred tax rate at 10% or tax rate at 10%, I now have an asset of plus 25k. How easy is that? As soon as that pro forma comes through, we can apply it in any situation, whether I'm talking about assets, whether I'm talking about liabilities. The first question in your head should be, is it a temporary or is it a permanent difference? I've made political donations in the year. They were expensed when it comes to my accounts, but they are not and they never will be tax deductible. This is once again a permanent difference sent to test you. And you're going to go permanent difference, no deferred tax impact. Let's have a look at my next one. I have received 8 million of rental income in advance. According to my accounts, this relates to 500,000 every single year for 16 years. Now, what happens when I receive cash up front for a service yet to be provided? Well, in which case I end up with deferred revenue or unearned revenue, which is accounted for as a liability. So I can do this question from a liability point of view and go per my accounts. I end up with, and let's go liability at T1. I've received 8 million of rental income, of which only 0.5 million relates to this period, and the remaining 7.5 liability I'm going to defer to future periods. I still have to provide 7.5 million of services. That's a liability. According to the tax authority, as soon as you receive the cash, that's income. So you don't have a liability, according to them, which is a temporary difference of 7.5 negative. That is going to be a tax, assuming a 10% rate, asset of plus 0.75. And I can do it from a liability. I could also look at my rental income. So I could say that my income per my accounts, I'm going to call it revenue, is 0.5 million. My tax revenue is 8 million. Both of those are positive. Well, 0.5 minus 8 is minus 7.5 million. And that will give me a deferred tax asset of 0.75, assuming that 10% tax rate. Last one. WNX borrows 650 grand on a 10-year interest-only fixed rate with interest at 12.5% payable annually in arrears. There is no indication in this question that there is a difference between what the tax authority is doing and what I'm doing. So here I'm going to write no difference. Well, if there's no difference, there's no temporary difference. And no temporary difference, no deferred tax movement. Okay, a couple more things and then we are done. Another thing that they can quickly talk about is they can talk about a timing difference and they can talk about what happens when tax rates change. And what I want you to have in your head is if a tax rate changes, then that will increase. And let's say my tax rate here, in fact, the tax rate here falls. I start at 40%, I end at 30%. That is going to decrease both my deferred tax asset and my liability. Before, if I had an asset, I was going to use that asset and offset 40% of my income, 40% benefit. But now I only get to offset it against 30% of tax. Essentially, this would be like you saving for a free coffee. So I buy lots and lots of $5 coffees and I get the coupons every period. And then just before I get to cash in on my coupon, the price of that coffee that I've been paying $5 a pop for drops to $1. And I get a free $1 coffee. So your deferred tax asset will drop when your tax rates drop. And that will feel to me like a loss. That fall in asset value will be a loss for your income statement, which is interesting when we think about now the US rates and we think about lower corporation taxes. Well, if I've got a deferred tax asset, I now get to use that asset at lower rates of income tax. And that is going to be a cost going for my income statement today. I've lost some of my benefit. So let's just quickly run through this example. I have accumulated temporary difference or timing difference here below the line of 100,000. And in fact, they've told me what it is. They've told me that I've taken an expense through my accounts of 100,000, which has not gone through the tax authority. So, first easy question, you should be laughing at these by now. Is it a deferred tax asset or deferred tax liability? What's deferred tax asset? If the tax rate is 40%, it's going to be That 100k times 40% plus 40k. How easy is that now? Per my accounts, I've got 100 grand of expense and I've got no expense according to my tax. Now the next year, and let's say that this is 2018, in 2019, nothing's changed. So I've still got this 100k of expense that's gone through somewhere or another, sitting on my balance sheet. My tax authority still allow me nothing. So I've still got this timing difference of 100k. But my tax rate has dropped to 30%. Well, my deferred tax asset is going to be 30% of the timing difference. So my deferred tax asset should now only be 30k, which is a fall in asset value of 10k. And that is going to be charged as an expense to my income statement. Now the opposite for a liability, if I had a liability, and I'll just draw it up there, so we're used to it. If I had a liability where, let's say it was the opposite, I was allowed nothing through my accounts and I was allowed to take 50k through the tax as a deduction. I end up with a temporary difference of plus 50, 0 minus 50, plus 50, plus 50, nothing's changed. And if my tax rate at 40% is going to give me a deferred tax liability of 20k, then if my rates drop to 30%, this liability, when I pay it off, I'm only going to have to pay it off at 30% rate. This is going to drop to 15k. And this drop in my liability, that positive 5k, is going to be taken through as taxable income during the period. So really, how am I affected by a change in tax rate depends on the direction of the tax rate, and it depends whether I have more tax assets than I do liabilities or more liabilities than I do assets. And those two are going to offset each other. Okay, let's just end with some conceptual true or false. A company makes a loss for the year. Is this likely, or this is likely to result in a deferred tax asset? And this one is just a nice conceptual one. I make a loss in the year. I take that loss through my accounts, and my accountants say you should get a tax benefit. The taxman goes, nope, you do not get me paying you cash today. What you can do is offset that loss against future profits. In which case, I'm going to defer that tax benefit to the future. So this one, true. Deferred tax assets result from gains that are taxable before they go through the income statement. Well, I'm just going to label this 2. I'm going to draw in my pro forma. So if I have a gain that goes through my tax before it goes through my accounts, I'm going to end up with 0 minus a positive figure, a negative figure. And that is going to give me a deferred tax asset. So gains that are taxable before they go through my income statement, true. Deferred tax assets result from losses which are taxable before they go through the income statement. Well, I'm going to have a loss here and nothing going through my income statement. 0 minus a minus figure is going to give me a positive figure, which is going to give me a negative figure here, which is a deferred tax liability. So, false. Deferred tax liabilities result from taxable income exceeding pre-tax income. And again, I can just draw this in. If my taxable income per my accounts my pre-tax income by my accounts is less than my income according to the tax authority. I've got a small number minus a big number, negative, and I end up with a positive, which is a deferred tax asset. False. An increase in tax rates will decrease a deferred tax liability. Well, you've just seen that an increase in tax rates is going to increase my liability and increase my asset. So this is false because it will increase a deferred tax liability. An increase in tax rates will increase a deferred tax expense. And this one you should be thinking, I don't know. It depends whether I have a net deferred tax liability position or a net deferred tax asset position. So let's go on to the next one that says, if deferred tax assets exceed deferred tax liabilities, a decrease in rate will do what? Well, in which case, my net deferred tax asset, I'm going to write my net DTA, is going to come down as my rates decrease. And a decrease in an asset is an expense in a period. Same way that depreciation is an expense charge, which decreases your assets. So that will increase my tax expense in a period. And the last one talks about a thing called a valuation allowance, which is where earlier on I said when you make a loss during the year, you get to offset that loss against future profits. Well, what if my future profits are never going to be large enough to absorb all of those losses? IFRS say just write down your deferred tax asset. US GAAP, which don't like you writing things down because you can't then reverse the impairment easily, say what you'll do is book a contra account against the asset called a valuation allowance. And this will bring down the value of your tax asset or deferred tax asset to recognise that you will not get to use all of this deferred tax asset or the old higher one in the future. So an increase in valuation allowance you can think of as bringing my asset down. And if I am bringing my deferred tax asset down, if I bring any asset down, that is an expense in the period. Same as depreciation is a charge for decreasing my asset. So that is true. And that there is about everything you can ask about deferred tax. Now forgive me for overrunning my hour session, but if you are interested in doing a study session via Fitch Learning, here are the contact details that you should have a look at. And I would like to wish you, whether you're studying with us, whether you are studying on your own or wherever you are studying, the best of luck in your exams. And I hope when that deferred tax question comes up, you're thinking, this is easy, run through it in a couple of seconds. Thank you very much.